Hey, welcome back to Living in Minnesota. My name is Joe Carmack, and it's time for your monthly real estate market update for the Twin Cities. Here's the three things I'm going to hit you with this month. First, we're going to talk some rapid fire stats of exactly whose offers are getting accepted and what the market's looking like locally. Then we're going to go deep dive into specifically the different trends that we're seeing in today's market, and you're going to see the big theme is going to be, is there a bubble bursting? Is the market going to crash? So if that's been on your mind, we're going to go real deep into what's happening locally. And then third, we're going to talk about forecasting for the future, what rates are doing, what we're thinking is going to come up in the next few months as far as rates and offers and changes in the market. So that's all going to happen right now. All right, let's get into it. So if you are new to the channel, first of all, thanks for being here. We'd love for you to subscribe. On this channel, I talk about all things moving to Minnesota, buying a home, selling a home, anything you've got. So if you're relocating from around the country, love to get calls from people just exactly like you. If you have any questions, put them in the comments down below. You'll also find in the description box all my contact info. You can direct message me on all the socials or whatever you want to do. I'm there for you. So, all right, let's dig into what we've got going on. Let me get my screen here switched for you. So, we are seeing a number of different things, and again, I'm going to start you off with the rapid fire stats of what we got going on in our local MLS. I love these stats because this is from a local company that talk about just exactly the offers getting accepted. So let's talk about this at a high level overview. Let's see here. Inspections waived. This has been a huge topic of conversation. 56% of the time we're seeing our inspections getting waived. That is up. That's tied for the peak of last year. So what that means is about half the time when buyers are getting their offers accepted, it doesn't include any kind of inspection. So we are getting in them the other half, okay? So it's not like it's an impossible situation, but something to be very aware of. FHA offers are having better luck at 6%. So this was very interesting. If you're an FHA financed buyer, first of all, there's a 94% chance that it's not. The reality is the majority of the market is conventional or cash anyways, which I'll show you. But for our FHA buyers, an interesting fact that they pointed out was they're seeing most of their FHA buyers are getting approved further outside of the Twin Cities, out of the metro. And so if you're looking directly in Minneapolis, St Paul, it's a little more competitive for that, but a little bit easier potentially if you are outside of the metro. So that was interesting. Appraisal gaps are included on 44% of offers that are winning. So that was interesting. If you don't know what that is, basically if you the home is listed for here, you get your offer accepted at here, but then there's an appraisal gap. So let's say the appraisal comes in from the bank at here, who's going to cover that gap from what you sold it to what it appraised at? Buyers are going to put additional cash down, like a down payment, to cover that appraisal gap. And that's 44% of the time. It's become pretty commonplace. Even if, I tell my buyers, even if you're only doing a couple $1,000, let's put something in there because it'll look slightly better than the other 56 that aren't doing any sort of appraisal gap. So it doesn't necessarily mean it's an entire gap coverage, but a lot of times it is. So very interesting. People have been asking me a lot about escalation clauses. Well, if we don't know what the highest bid is, then I don't know how high to put my bid for our offer. 5% of the time those are being used. So an escalation basically says we'll trump another offer, kind of like an auction, up to our max. They're just not being used because everyone's just putting in whatever their max number is. So that's where we're at. Offer acceptance rate is the last thing I'll point out here, 45%. So typically that's going to mean buyers are making 2 to 3 offers till they get theirs accepted. So you're going to see the theme of a lot of what I'm going to be talking about today is the market's not crashing and you can actually buy a house, which isn't just realtor hype, right? I'm just not trying to convince you to buy a house or sell or whatever, but people are feeling discouraged, but it's not as dire as a lot of people are thinking. So there's your rapid fire stats for you. Let's do a deep dive into what the market's doing. And you're gonna see, I'm gonna give you these charts a little bit different. So if you've been following me for a while, I usually break down a very granular month-to-month rolling change. And so you'll notice on this median sale price graph, for example, it's usually a lot more seasonal like this. So we're gonna scroll out. What you're looking at here on all these graphs, it's gonna be a rolling 12-month average, okay? That's how we typically look at them when we're looking at kind of a wider lens macro picture of our real estate market. So real estate sales prices. Let's look at exactly what's going on here. So do I have my little marker? Let me do that for you. Okay, so here's what I want to point out. This is the peak of the last bubble, okay? And then everything popped and dropped, okay? So that's what happened right here during this whole time frame. Now, what you need to understand is, if we're looking at a 4% trend line, it's probably going to look something like this, okay? So our market had been overinflating, bad lending practices, a bunch of other stuff going on. That's what got this bubble over, And then when the government stepped in, regulated all of that, which they needed to have already been doing, then all of a sudden, for a number of reasons, the market dropped then. This is what the Great Recession looks like if you want to put it on a statistical graph type of form. Everything that happened, back in 2000, if I could talk, 2006, 7, 8, 9, 10, that's exactly what happened for you. So when people are saying, oh, the market's going to crash, this is what they're suggesting is going to happen, okay? Interesting. What happened, then you can see, obviously, we dropped, we rebounded, and we're approaching that line, and we were thinking, all right, then it should kind of start to even off, right? Well, then all of a sudden you can see right in about here, we had this little thing called the pandemic happen. And then you can see during that stretch of time, things actually just shot up more even than expected. What's interesting now is if you take that out of the equation, the amount we've been going up kind of in this time frame is not terribly different than what we had before. It's still going up, prices are still going up very quickly. But overall, if you took out that snippet of time, it wouldn't look nearly as crazy because we're getting back to some form of normalcy, whatever that means. March, we were at 354,000 for our median sale price in the Twin Cities. That was up 14,000 from February to March. So that's actually about average. I went back to several, 3 or 4 or 5 years. I think I looked back. 14,000 is about actually the average increase from February to March. That's obviously not going to happen every single month, but as we're coming out of the winter into the spring market, that's a pretty normal number for us. So no huge changes there, nothing that's majorly concerning. Month supply of inventory. So let's look at this one here. If you have followed me for a while, you're going to know too that month supply is the relationship between are we in a buyer's market or a seller's market. We want it to be somewhere in here, 4 to 6 months in that range would be balanced. If it's above there, then it's going to be a buyer's market. If it's below, it's a seller's market. Okay. If we're looking at a rolling 12-month, there's no big change. We've kind of bottomed out. I am not sure how much lower this can go logistically. I mean, it can, but for our rolling 12, we wouldn't expect it to go too much lower. But as you can see, it's not ever been as strong of a seller's market in quite some time. What is a little bit of a light at the end of the tunnel, and let me clear those off for you. Well, I'll leave them. So if that's our balanced market, we did see, here, I'll zoom in for you. We saw a little tiny raise, so this is from February to March, it came up. I mean, it might just be a tiny amount, but we'll take whatever we can get. So we did come up 0.1 month supply of inventory last month. The average is about 0.2 between February to March, so it's a little less than we would like, but it's not a significant enough difference that I'm terribly concerned myself. Oops, let me fix that for us. There we go. So that's what our month supply is doing. We're still in a very, very strong seller's market. I want to actually back up to here for you. Again, with people talking about, okay, the market's crashing, there's got to be something on the horizon, right? Let's think again. You've got to get in between these lines to be even balanced. So back here, this was the last recession. Month supply doesn't necessarily reflect that, okay? But then all of a sudden, it went like this. And, that was the big Great Recession. What you can see here, though, is this didn't happen overnight. So I'm hearing people that are like, well, I don't want to buy a house now. I'm going to wait till next year because then the market will be better. Well, look at this graph right here. Okay, this was the Great Recession, right? And over this period of time, how many years did this take, right? If you want to call your peak halfway through 2005 to halfway through 2008, maybe? Okay, great. So my question is are you going to wait 3 years to hopefully have the most optimal time? And with this being the Great Recession, what do we think is going to happen? Like half that difference? Or is it going to take twice as much time but be the same amount? So you're really not going to see that swing that quickly. And even if you did, we're not talking next year. We're talking in a few years, the curve might start going back the other direction. And I'm talking a lot about more again at the end of what we're forecasting, but let's just be honest. Do we have some room to go? Would we love it to start swinging up? Yes, definitely. But in all reality, is that going to happen anytime, immediately, or soon? And the answer is unfortunately just no. Oops, there we go. Okay, now let's look at the number of closed units. And actually, I'm going to switch for you. I'm going to give you the number of new listings coming into the market first. Okay, first of all, number of new listings. You can see, again, we're just gonna have to keep talking on this because you gotta zoom out and see the bigger picture this month. This was the big boom. tons of new construction going on, tons of new listings, prices were high, everyone's like, woo, we're gonna sell our house, right? Then all of a sudden, the market shifted and, very few people could sell. It was really hard to get your home sold. People were underwater. Values dropped, so people couldn't sell, okay? We then started to rebound, and then we've been fairly flat since about 2014 or so, okay? Here's what you need to point out. The number of new listings coming to the market is actually pretty good. I mean, it's fairly normal. It's obviously always changing, and rates will change, and different things, cycles will happen. But overall, people have talked about an inventory shortage. First of all, it's not a number of new listing shortages. We're still seeing the relatively same amount of new listings coming into the market. And so buyers that are saying, well, there's nothing out there. It's actually not that there hasn't been more out there. It's just that it's going off market so quickly. So it's the matter of you just have to act faster in a shorter period of time because the home hits the market and then it's sold a couple days later. And so it's very rapid fire off and on. Buyers just intensity has increased a bunch. Back to our month supply graph, there's also a lot of buyers for that same number of listings. So we still have a healthy number of homes that are being listed. We've just got a lot of buyers that are competing for those, which is speeding up the speed at which everything is happening in today's market. Now then, let's go back to our closed sales numbers. All right, let's just, for the sake of discussion, I'm gonna skip ahead, but let's just mark this side out of our equation because obviously that was Great Recession. There was a boom, there was a bust. So let's just kind of zoom in on the other part of it. And that would be through here. So what is normal is part of the question of how many closed sales we should have. And I'm going to be honest, I don't know. When we exclude the Great Recession, I don't know locally how many homes we should be selling per month. Last month it was a little over 65,000, but you can see if we kind of average those previous decade or so, we're down around 60,000. Okay. Here's what you have to understand. Then all of a sudden we had let's do pandemic happened in here, so that kind of got a big rush of number of homes selling. That's when kind of that excess inventory got sold off. And so then this is where we're at right now. So back to our conversations of, is the market crashing and what should you be doing? First of all, a ton of buyers are still getting their offers accepted. What does closed sales mean? It means people exactly like you that are wanting to buy a house, that are successfully doing so, and there's more people doing so now than ever. I mean, you look at the graph, okay? At least as I can only go back to 2005 is how far our metrics work. So there's never been more people per month that are successfully buying a home. And if they can do it, you can do it, okay? Short of some massive, you have no job or some obvious issue. But for the average Joe Schmo, they're being able to successfully buy a house. So don't let the market discourage you. It may not be easy necessarily. It's fast and aggressive and you got to move, but people are getting their offers accepted. And so, don't be discouraged because you can totally do it. Second part of this equation is, well, what happens if the market crashes? First of all, let's say we see a huge dip in the number of homes that are being sold a month. Let's say, I don't know, 30%, okay? Something like that. That would then still drop us down into what, like this range? We're still not even close to where it was beforehand, okay? We would have, almost double of those number of homes, okay? I'm sorry, not double, but substantially more, you can see. So my question is, when people are thinking the market's going to crash, there's going to be a bubble bursting, what data is that getting based on? And if there is a shift in the market, don't we have a really long ways to go before we're really going to feel the impacts and it's going to be, devastating for people, or people are going to be upside down on their mortgages and stuff? That would be my argument to it. So what's happening for the next several months? Here's what you need to know. First of all, rates have gone up. They've gone up pretty darn significantly. I had a client just recently, they were a little under 5.5% and they were stoked, right? That's a great rate for their situation. I did have another one that was slightly under 5, which they were obviously very happy as well. But that's kind of where rates are at. They're 5%-ish, 5.5, somewhere in there. That feels devastating to the people that were previously looking at homes at 3% interest rates because it massively changes your payments. So I want people to focus a little bit less on the sales price, to be honest, and more on the interest rates, because it's like they're just not even paying attention to rates, because that's affecting your payment dramatically more, and that's affecting housing affordability. So number one, keep an eye on interest rates more than sale price. Sale price matters, obviously, but interest rates is the biggest factor. So what is we looking like if we fast forward 6 to 12 months? The Fed said that they're going to be raising interest rates, I believe 6 times across 2022 is the last heard. They've done it a couple of times already, and that's going to keep going. So maybe we'll be up another 0.5 to 1% interest rates over the next 12 months. That's a pretty realistic scenario, and people need to, again, keep an eye on that. As far as prices going up, we're still saying double digits, 10% or so is probably the average of the talking heads that I've been listening to, that they're expecting will go up. So is the market crashing? Nobody knows for sure, but there's a lot of data suggesting that it's not, or that if it does, it's not going to be fast, it's not going to be significant overnight, that sort of thing. But what we do see happening is inflation's going up like crazy, prices are going up, and interest rates are going up. And if you are going to wait, again, I mean, have you followed me? How many times have I said I wouldn't tell someone to move based on what the market's doing? And I mean, I got 4 little kids, man. If you want to move and call me in 10 years, I'll be around. It's cool, right? I got colleges to pay for these kids, but I'm not pushing people to sell now as much as I'm just saying you have your eyes open. You need to realize prices will be more and interest rates will be more in a year from now, and so that's going to affect you pretty significantly. If you're going to be staying in the home for, let's say, 10 years, I want to pull this graph back up for you actually. If you're going to be in the home for 10 years, let's see, let's change this for you. Sorry, get my technologies to work for us. Look at the sale price. If we scaled this back over about 50 years, there's almost no points in time over a 10-year period of time where you would be underwater, okay? Because prices go up 4% a year. So if you're in that home for now, let's say you are overpaying for today's market and prices go down, 10 years from now, it's almost a guarantee. There's almost 100% chance that you will be worth more on that home than you are now. So in that sense, the price is less significant than the interest rate that you're paying on it, which you will be stuck with for 30 years because rates are probably never going to come down back to where they're at now. So that's what's going on in the Twin Cities right now. Again, my name is Joe Carmack. I would love to help. I love getting calls from people. I probably get 1 or 2 a week every week from YouTube people just like you, or Facebook, or wherever you're watching this. So don't hesitate to reach out. You'll find all my contact info in the description down below. You can check out joecarmack.com and get my buyer's guide, and I am here for you if you're thinking about moving to the Twin Cities. So thanks so much for watching. Make sure and subscribe, and I'll see you next time.